Hey, hello and Happy New Year. And from everyone here at Off Piste Wealth, we hope you all had a wonderful Christmas break. And so in this video, we wanted to give some analysis to what we saw in financial markets during 2022, which I'm sure we can all agree was extremely volatile, to say the least. And in this monthly roundup, I'm going to be giving a financial update and also providing some details to what we expect to come in 2023. And so before Christmas, the Federal Reserve, Bank of England and the European Central Bank all raised rates again, taking base rates to the highest level in well over a decade. As 2022 drew to a close, many will now be looking to the new year, hoping that the world will finally shake off its post-Brexit, post-COVID hangover and give investors some more cheer. Looking forward to that. Despite most regions of the world moving back to normal, markets have, however, been battling a very difficult backdrop. We've seen the highest inflation in a generation, which has led to the most aggressive rate rising cycle in modern history. And therefore, how to tackle that has become a concern and a problem. As we all know, Putin's invasion of Ukraine has spiked both energy and food prices, with many facing a cost of living crisis. It is therefore unsurprising to hear of the comparisons that we're in now to the winter of discontent that many people may have seen back in 1978 and 79. Quite a lot of comparisons to draw there. So, what did we see in the last quarter of 2022? Well, given the uncertain backdrop, stock markets actually rounded off on a positive note, with gains towards the back end of last year, which was fantastic to see. Asian shares were boosted by China's relaxation of its zero COVID policy, while European equities also advanced strongly. Government bond yields did edge up towards the end of Q4, meaning that prices did fall, and therefore this reflected some market disappointment at major central banks as they reinstated plans to tighten monetary policy, even as inflation showed signs of peaking. So over to our US cousins, the equities in the US also made robust gains in Q4, with much of the progress made in November. Investors balanced ongoing caution from the Federal Reserve with indicators that a pace of policy tightening would slow and signs that elevated inflation could be cooling. There are also especially strong corporate earnings in certain sectors. Closer to home, in the Eurozone, shares also notched up a strong advance in Q4, outperforming other regions. Gains came from a variety of sectors, notably economic sensitive areas like energy, financials, industrials, and consumer discretionary. More defensive parts of the market, such as consumer staples, lagged the wider market advance. Back at home, UK equities rose over the quarter, helped in part by the countries emerging from its September crisis. Markets had been volatile in September as the former Prime Minister and Chancellor announced huge financial stimulus with little detail really on how it would be funded, causing the major issue there. Many of the policies announced in that September mini-budget were reversed as the new Chancellor, Jeremy Hunt, used the autumn statement in November to promise that the country would tighten its belt in the future. His assertions were supported by fiscal and economic forecasts from the Independent Office of Budget Responsibility, which was obviously missed out in the so-called mini-budget, causing the issues. More broadly, economic sensitive areas of the UK equities outperformed in line with other markets. This occurred amid hopes that the US Federal Reserve might be in a position to pivot to cutting interest rates in late 2023. And given the backdrop of Brexit and other economic pressures, it has to be noted that the UK was actually the third best performing country last year, first being India and second being Brazil. This just goes to highlight how volatile 2022 actually was for global markets. So what was the overall picture like in 2022? Well, we saw kind of historically low monetary policy, i.e. interest rates, and extremely loose fiscal policy, i.e. furlough schemes, back during the COVID crisis. And all this meant and kind of almost abundance of liquidity that had worked in saving the global economy whilst we were basically housebound. However, as we started to travel and things started to open back up, we started to consume more and go back to the office. It was apparent that rebounding demand was not being met by supply. Therefore, something had to give. The inflation genie was therefore out of the bottle, and central banks, whose inflation targets are generally 2%, were behind the curve and worried. Hence, the tightening of policies that we saw at the beginning of the year. However, it has to be said that we expect a brighter future moving forward. As stated, markets have been stronger in the run-up to the end of the year. There are genuine signs that inflation is starting to slow. The price of shipping oil, used cars, houses and commodities are stalling. Higher borrowing costs and the cost of living crisis is taking its toll on growth, has to be said, and stalling and growth means that falling demand for goods and services. This therefore does mean less inflation, which is good. So yes, we are entering a slowdown. However, markets are very quick to forecast this and are now looking for signs, usually over the next 6 to 9 months, that we are through the worst. While things may look bleak, continually good news regarding inflation, Ukraine's advances against Putin, and China's easing a bit gradual of its zero COVID policy should translate into stable returns over the next 6 to 12 months. So, in brief, for 2023, what do we expect to happen? Well, despite remaining above central bank targets, inflation should start to moderate as the economy slow, as economies slow, the labour markets weakens, and supply chain pressures continue to ease, and Europe manages its diversity of its supply energy. Our core scenario sees developing economies falling into a mild recession into 2023. I have to stress mild. However, both stocks and bonds have preempted the macro troubles set to unfold in 2023 and look increasingly attractive. And bonds are looking even more attractive now than they have been over a decade, which is very good for investors. Of course, the broad-based sell-off in equity markets has led some stocks with strong earnings potential trading at very low valuations. Again, good if you wanted to get into the markets now. And so we think there are fantastic opportunities in climate-related stocks and also in margin markets moving forward. So, as always, if you would like to get in touch in regards to anything I've spoken about today, or indeed in regards to your own holdings, please do get in touch, and I look forward to hear from you soon. Thanks ever so much. Cheers, bye.